Hey everyone, I'm your host for today, Anwar Adam, and I'm part of the Noyack Wealth Club. Welcome to Inheriting the Future, our podcast where we are dedicated to help young investors navigate the world of private investments and personal wealth management. Today, we're diving into the impact of skyrocketing property insurance costs on homeownership, especially for young buyers. With premiums rising sharply across the country, we will explore how these increases are reshaping the housing market and what steps you can take to navigate this growing challenge. Joining us today is our guest expert, Todd Rockefeller, who is a personal insurance practice leader at AccessGranted with over 3 decades of experience in this industry as a personal insurance advisor. Todd, we are glad to have you here.
Anwar, it's a pleasure to be here. Thanks for the introduction.
Of course. So, Todd, let's go ahead and dive into the questions we have for you. And the first question for you, Todd. So, Todd, we're seeing skyrocketing property insurance costs, particularly affecting young home buyers. What are the main factors driving these sharp increases, and how do they impact a first-time buyer's ability to secure home ownership?
It's a great question, and I work with a lot of young buyers. And what happens is when you're taking a loan, there's a certain ratio that must be maintained, and there's certain insurance costs that get baked into a first-time mortgage payment. And the higher the insurance is, the less buying power you have. So it's critically important that young buyers are able to shop around and find the right company, the right fit, and the right cost so they can hopefully fit into the home that they desire. Now, what's driving these costs has been labor costs, which is inflationary, material costs, another inflationary metric, the cost to reconstruct a home. These have all risen and really dramatically since the pandemic. And we're not seeing a retreating of these costs. We're actually seeing a new normal. And ultimately, what's driving those costs are the types of losses that the insurance companies have experienced. So these are private companies. They need to return certain equity to their shareholders, their business. So if they're experiencing increased water losses, fire losses, hail losses, tornadoes, hurricanes, ice storms, all these things that you hear about in the news, obviously, we've all been tuned into the Los Angeles fires. That may be happening a world away, but it affects all buyers around the United States because insurance at its heart is a risk-sharing mechanism. And we all share risk. We pay what we would hope is a little for a lot of coverage. Increasingly, we're seeing paying a lot more for that same coverage. So thanks, Anwar.
Thanks for the answer, Todd. Now, going to our second question. High-risk properties in coastal and wildfire-prone areas seem to be seeing the biggest insurance hikes, as we just mentioned about the California wildfires and potentially even the hurricanes that were impacted in North Carolina a few months ago. All these attractive home buying destinations, for example, maybe Miami or maybe California or North Carolina. How would these, how should prospective home buyers approach these regions, and is it worth it?
Increasingly, it's not worth it. We've seen a large number of clients migrate down to Florida, let's say, a nice tax haven, even Texas. And what happens is they might save on some personal income taxes, but they get hammered with the increased cost of insurance. So unfortunately, the way the world is created, some of the most beautiful coastlines and destinations are in the most hazardous area. So you take all coastlines and then you add in, Colorado, states with wildfire concerns like California, and the cost to secure your home insurance, even auto insurance in those areas, is going to be higher. Unfortunately, the only way to manage cost at times is through avoidance. And for a first home, whether it might be great, but it might not be worth the investment, because if you do purchase, and you are a young buyer and you do have a mortgage, you will be required to have the wildfire peril, the hurricane peril, maybe even flood insurance, and your costs will be incrementally higher. For those buyers who are, in their 40s and 50s, and maybe they have a slightly, better financial position, they can afford to not have any insurance, or choose maybe more restrictive coverage policies in the marketplace from places like Lloyd's of London, where you have less coverage, but you also have some less cost. So it's a complicated landscape. I would stay away from the coast if you're looking to manage insurance costs at this time, for sure.
Got it. Thank you. And, as a follow-up to that, like a small follow-up to that question, I and a lot of, young individuals, we want to move to somewhere like Florida or, like especially Miami. Just it's more fun, it's warmer, we get to enjoy most of our time there. But, you mentioned this, but that's not, it's coastal area. But like, what are there any areas in mind that come up to you that young home buyers should potentially go there if they're thinking in the sense of avoiding property damages or high insurance premiums? Like, do you have any states in mind, or potential major cities that are away from flooding or wildfires or just general nature related property damage or climate change related property damage?
Yeah. So I do have an answer, but I'm going to
Okay.
preface it by saying, no matter what side you fall on the climate change discussion, I think we can all agree that there is a change in climate. No matter how it's caused, it has changed. And no matter where you choose to live in the United States, there's increased hazards. I mean, we just saw 2 to 6 inches of snow across the Southeast. We're seeing increased convective storms and heavy hail damage in the Midwest, a former haven for non-catastrophic loss. We've seen places like North Carolina to be, moderate and a great place to live. And here in the mountains of Asheville, North Carolina, and so forth, tremendous flooding, death, destruction. So the answer is the non-catastrophic areas, and they still exist. Unfortunately, often not near metro centers where young professionals really need to find work. Vermont's a wonderful place to live. There is Burlington, Vermont. There's just a hub and a metro, but it's also cold. It's not as fun. If you choose to get to Florida and you want to get there as a young person, possibly renting might be the solution to get your toe in the water. You're not building equity, but you're at least trying it out. And you know what? South Carolina, most of North Carolina, Virginia, these are places where you can still find a reasonable climate, a robust professional atmosphere, and you're still mostly escaping convective storms, hail, hurricanes, tornadoes, etc. They exist, but less. And the companies haven't priced for it yet. So that's my answer there. Mid-Atlantic's beautiful. Midwest is fine. Southwest is fine. The minute you get back to coastlines in California, you're back to cost.
Got it. Thank you. And now let's go into a question that's more related to finances rather than setting up which place to move into. Now, with inflation, obviously, and with the rising costs and the impact on property values, what can young home buyers do now to safeguard themselves against the financial strain of increasing premiums? Because on one end, we have inflation that is all over the place, and we have wages that haven't really gone up too much, on par with inflation. And what can these young professionals do, young home buyers do, to safeguard themselves against this financial strain of increasing premiums?
So the best thing to do is to still look to bundle insurance. Look to put your home insurance with the vehicle. your home insurance with a vehicle and jewelry and an umbrella policy, an insurance carrier is going to price and model out the best cost for you if you put everything together. And that's not a secret. You see the commercials, and it's true, and it should be done as often as possible. And then once that coverage is purchased, you look at your deductibles. Of course, a deductible means you pay out of pocket first. Typical home deductibles in the past for many, many years were $500 per property loss. A tree falls on the house, you pay the first $500, the company pays the rest. The $500 is gone. $2,500 should be a consideration. $5,000 should be a consideration. And before you say that's ridiculous or I can't afford to be out of pocket that number, look at the cost break. Have the insurance agent show you the break between what the policy costs with a $1,000 deductible versus $5,000. You may save $2,000 a year with the higher deductible. Actuarially, a homeowner has a loss every 7 years. It could be small, it could be large, but if you were to put $2,000 in your pocket every year for 7 years before that actuarial loss occurs, you're way ahead of the game. And theoretically, you should be able to pay that larger deductible at the time that event happens. So bundling larger deductibles, that's the key. I'm sorry to cut you off. Shopping around is good, although it should be done. We encourage to have an agent do that for you, just like a travel agent shops for you. An agent shops for you. It doesn't cost more. They represent many companies, and what happens when you find that company, the hope is to stay with them for many years. Maybe reprice the insurance once in a while. That agent can do that for you. And we like to say, after 3 years, let's go to the market and be sure that what I have is not outside the market on cost. But the tenure you have with the company does matter when it comes to claims time. So we try to find the right policy for the family's need and tweak it over time with deductibles or even deleting coverage that may seem like an extra at this point. So, thanks, Amar.
Yeah, of course. And, something just popped up to me, what I've been hearing on the news, I'm not an expert like you, and you would obviously know the right answer for this, where, especially right now with the California wildfires that has been happening, a lot of people, have lost their homes, but their insurances have backed out, despite these people paying, for decades sometimes. And what could, young investors, young home buyers do to, is there a way that they can avoid being in a situation like that? For example, let's say they've been paying their premiums, for the past 10, 15 years, and now all of a sudden an issue happens, like a wildfire or some disaster, but now the insurance backs up. Are there ways that these home buyers could, come out with something to benefit them at the end? Or is there just nothing about it?
Yeah, so the insurance business is pretty antiquated, right? If you look at the scope of the change over the past several decades, in the last certainly 10 years with, an Amazon, a Microsoft, SpaceX. These are very progressive industries. Insurance is more staid, financially driven, and the shareholders who invest in these companies, it's almost like a bond-like investment, and they expect, returns and stable balance sheets. And the clients who have purchased these policies, they too expect a stable environment, solid balance sheets, so the claims get paid. As I said, I think at the top of this call, these are private companies. They have a responsibility to their shareholders. So the government can't say, geez, Todd has been paying into this policy for 10 years, and the company shouldn't be able to cut and run on him because he had one incident, or now we've realized that he lives in a hazardous wildfire zone. But the truth of it is, the while highly regulated, the companies do have the option to be unpopular and move away from high hazard areas, and we've seen that. Consumers do not have a recourse. So the defense is to try to work with a company that is big and stable and is not undercutting the market on cost, because when the chips are down, they will stick around. They will stay. It's a complicated landscape, and there's really no answer, and that's the truth. But if you can purchase insurance through, a Fortune 500 firm, an A-rated balance sheet by Best, you're going to be in a lot better position long term, even though the cost today would be 5 or 10 points more than the cheapest policy on the street, because they're in it for the long haul.
Yeah, that actually makes a lot of sense. Just not maybe thinking more about the overall general safety as well, where pretty much like investing in like a stock or any kind of investment opportunity where you have to, do your due diligence on. Now you have to do due diligence on the insurance company itself, if they're financially stable, to support you when times, go bad for you. So yeah, I think that is actually a good advice for the listeners, where they can focus on getting the coverages from insurance companies that have been stable and also have, during tough times, have been helping out to individuals perhaps, and just looking at the overall financial health. And also, on top of that, do you recommend, maybe like insurance hopping like every 3 to 5 years, or just stick with it if everything's going well?
More times than not, we suggest stick with it, but
Okay.
We only suggest that to our client once we've shown them what the market looks like, right? It's very important as a consumer to understand, be educated. And it's my job to educate the client as their trusted advisor, to say, listen, this is what you have. I know it feels expensive. We've looked at these 5 other options, and the company you have is within the marketplace, and there's no need to cut and run. What happens too, when we move clients around, we open them up to new scrutiny. The new insurance company will do an on-site home appraisal. They will come out to the home. They will pick on the property, right? They'll say, geez, there's some trees that need to be trimmed. You should really install an automatic water shutoff. In fact, we're going to make that a critical requirement. It needs to be done in 60 days. So now there's inconvenience and expense. Now they've picked up that there's a railing missing or a crack here or there. And I think the most impactful reason where a change can get you into trouble is that new appraisal may appraise the reconstruction value of the home much higher than it was before, and that just drives costs too. So these things can be done. It just needs to be done with a professional who can advise you on the pitfalls and keep you out of those scenarios.
Absolutely. And now, going back to a few questions back, following up on that, looking at the broader economic picture, how do you think these insurance costs will impact the overall housing market? This also includes for the rental prices as well, and overall the housing affordability in the long term.
In certain markets, and that's back to the catastrophic markets, especially, and of course, think catastrophic and then think the most beautiful, sought after places to live. Miami, Florida in general, coastlines. I think we will see house prices potentially suppressed a little bit, because the carrying cost of these properties, the cost to maintain annually, is getting larger and larger and larger. And this goes back to the top of the call here, where if a young buyer takes a big mortgage, but that mortgage payment can't get any bigger because and the insurance cost makes the ratio, the loan to property ratio, too high, something's got to give. Either the insurance company, the agent needs to find a different insurance company, or the buyer may have to lower their cost so the mortgage can fit into the lending ratios. So simple answer, it could absolutely create a suppression of home value. It could over time.
Got it. And, one last question for you for today. This is more for investors, right? Home buyers.
Mhm.
The focus is, as, you have yourself have, given advice to going towards buying properties in potentially where low risk areas. So for investors, the focus is shifting to resilient developments and
Mhm.
lower risk areas. And how should they adjust their strategies in light of these rising insurance premiums?
Mhm.
And what's the long-term outlook for property markets facing these challenges?
Yeah. So when I think of resilient housing market or resilient developments, if we look at some of the areas in the states we identified that were still attractive to insurers, and let's take that Mid-Atlantic state area, and then we look at new housing developments that have all the protections because they're to current building code, this becomes very attractive to insurers. The newer building codes have special roofs to be better fend off hail and wind. The roofs themselves have strapping to keep the roofs on the homes. Many local ordinances require residential sprinkler systems. So now these fires get put out very quickly. You've also got PVC pipes instead of old copper pipes or other infrastructure that's decaying. So a younger investor, a younger home buyer, if they could look past that big bucolic yard and focus on a newer construction that may cost a little more up front, but the insurance cost and the maintenance cost will be a lot lower, I think the young investor is a winner. And long term, the insurance companies are increasingly attracted to that type of development, and you're going to have a more stable insurance cost environment.
Okay. So, you're recommending, investors to go ahead and buy newer properties just because they have, newer technologies that help fight these natural, calamities, maybe hail or maybe flooding.
Correct.
Okay.
We see, so one of the questions that our underwriters ask in almost every case is what year was the house built? And the minute they know when the house was built, they'll understand what materials were required to go into that home at that date or later, and they'll understand that it's going to be a better risk from infrastructure, pipe, wiring, heating, more resilient roofing and siding. That all plays into insurance cost. Absolutely.
Got it. And that's it and that's a wrap for today's episode. Todd, thank you for joining us today, and it was a pleasure to speak with you on this topic. And
been a pleasure, Anwar. I appreciate this. Thank you so much.
Yeah. Now, to our viewers for tuning in, if you enjoyed today's episode and want access to more exclusive personal wealth management content, be sure to click the link in the description to subscribe to our newsletter or scan the QR code. Bye for now.